Looking ahead to the CPI report again tomorrow, how important is it for the markets in your mind? Again, the meeting's not until March. We actually have another Fed meeting before that March meeting. But do you see it as a market mover?
Yeah, I do and I don't. So to your point, there's a couple more key data points before March. So I think the market will be able to digest tomorrow's report pretty easily, no matter how it goes, because you'll still have a whole swath of data in late January and February before the Fed has to make that call. But at the same time, it is the first kind of major data point in a while that should give guidance on where the Fed will go. I think some of the volatility in the early part of the year and some of the rally in the late part of last year was around this idea that the Fed was pulling forward some easing. And you mentioned the odds of a March cut. I'm still a little skeptical they're going to cut in March. So if inflation comes in, outside of investor expectations, even a little bit tomorrow, I think it could, merit additional recalibration. But yeah, I think tomorrow will be important, even if it's not the end all be all.
So even if it doesn't move the markets dramatically one way or the other, do you think it might be a catalyst to get some of the money that's on the sidelines off of the sidelines right now? About $1 trillion in money markets.
Yeah, absolutely. We're looking for those catalysts that kind of confirm a soft landing, confirm that this year could be a strong year in earnings growth as well.
Okay.
Big story last year was all of the money that moved into cash, not into equities, which returned, close to 27% last year, but moved into cash. You're getting a 5% yield, but that does represent cash on the sidelines. So even though we see some traditional sentiment indicators a bit off sides, there's still this kind of more structural force that could add fuel to the fire if we get
Ross,
confirmation.
I hate to interject, but you're bringing up sentiment, something really important I want to talk to you about, actually. Jeffrey Gundlach out yesterday saying he doesn't like the market conditions. He's actually pointing to the S&P making a double top from its highs back in January of 2022, reaching just about the same level currently, basically saying that's a bearish technical indicator. Do you agree or disagree with him?
I'm more bullish than that. I think earnings growth this year, even if it's not in the double digits, high single digits, soft landing still looks good to me. Inflation coming down rapidly, labor market tight. So I'm a little bit more bullish than that. Sentiment here is probably a bit offside. So a near-term consolidation or correction, totally fine with that. But I think amidst the backdrop of a more cyclical bull market, rather than a topping market here.
One other sentiment question. You like industrials right now. I do want to ask you about them. Do you see them as expensive, first and foremost? Trading at just over 19 times forward earnings. Historical average is about 16 times forward earnings. And then the earnings estimates. They've actually declined pretty dramatically. We're showing the audience. Back on October 1st, 6% earnings growth forecast for Q4. Now it's down almost 1%. Getting a new estimate from LSEG coming out on Friday, but these are the current ones right now. Does that concern you at all about industrials, that the earnings forecasts are declining so dramatically?
A little bit, but I do think it actually sets up for kind of an easier earnings season. That's usually the case. Part of the reason we like industrials is a little more structural as well. Some of the tailwinds from infrastructure spend, aerospace and defense spend, onshoring, reshoring. So there's the soft landing, and then there's the more structural forces that I think are a bit outside this year's earnings estimates. Finally, as far as valuation, yes, a bit expensive, but I do think it's going to be hard for investors to find something that's not a little bit expensive here.